Welcome back, part 5 of merchandising, and I'm Judith Paquette. Part 5 will cover the periodic inventory system, and you need to understand this one too. For purchases and sales, you need to know the journal entries for these. So what is periodic again? It's used in certain industries where they don't maintain a running account of changes in inventory. Products, it could be used for certain products where you just don't need to track the balance by item, usually in small cost items. For example, in a hardware store, you wouldn't track every sale made by nail. That would be silly. That would be too much tracking. You would just periodically count the nails and the screws and the nuts and the bolts that you have on hand, and then calculate cost of goods sold and then make the journal entry. So when we book the sales journal, we are going to say one entry for the sales side and no entry at this time for cost of goods sold. So you will not see the debit to cost of goods sold and the credit to inventory at the point of sale. You'll see it periodically. We will make a journal entry. We'll just do it periodically. So here we are. Here's our sales journal entry. We're going to start with that. So we're doing Judith's Books, periodic. To record the sale, to Jennifer's Office Supplies. Debit accounts receivable, credit sales. No entry for cost of goods sold, no entry at this time for inventory. This is the same first two lines that we used for Perpetual. And the same is true for sales returns. Again, when we did the sales returns for for Perpetual, it was a 4-line journal entry. This is a 2-line journal entry. Debit to sales returns and allowances, credit to accounts receivable. Finally, when the customer pays, we're doing Judith's Books. When Jennifer's Office Supplies pays, Judith's Books debits cash, debits the sales discount, credits accounts receivable. So those entries are the same for both Perpetual and periodic, except that for Perpetual, when necessary, you'll book cost of goods sold and inventory. So now let's look at the purchases. It's very similar to how we treated the supplies purchases in earlier chapters, in the adjustment chapters. We buy the inventory. We later count the inventory to figure out what is left and what was used up. And by used up, I mean what was sold. The difference here with periodic is that we track this all in individual separate accounts to record the purchases, to record the freight costs, the returns and discounts. Company does not maintain a running account of changes in inventory, as I already said. Inventory is counted periodically to see what is on hand, and then cost of goods sold is calculated and a journal entry is booked to adjust the accounts, and we do it periodically. So here's part of the multi-step income statement for companies that use periodic inventory. So earlier I showed you the full multi-step income statement for Jennifer's Office Supplies. And you had one line on that statement for cost of goods sold, $142,200. For periodic, it's a little more complicated, but it should make sense to you. Just like with the supplies account, we start with the beginning balance in the inventory account. We add the purchases. We subtract the returns and allowances. We subtract the purchase discounts. Add those two together. We add the freight in. Add those two together, and we have the cost of goods purchased. We add the cost of goods purchased to beginning inventory, and we have cost of goods available for sale. Now, at the end of the year, and for this company, the end of the year is the last day of February, we physically count what's in inventory, and we have 11,850. And so we subtract that from cost of goods available for sale, and we come up with cost of goods sold. Now, when it comes to this report, this section of the income statement, obviously at this point it would be nice to be using Perpetual, because we just look at that account balance and plug it in, taking into account any adjustments that we might have had to make. For, per, for periodic, you have to add all these, do all these transactions. And just like on my other multi-step income statement, wherever I've got the lighter color here, per, you, are subtotals or totals or calculations. Wherever I don't have that, where you just have the blue background, those are actual account balances. So here we go. Inventory beginning balance. Purchases is a new account for this chapter, 143. Purchase returns, 11,200. Purchase discounts, 2,654. Freight in, 13,004. Now this ending inventory will be an account balance, but for this point in time, it's what we physically counted. So you have 4 new accounts for periodic that are only used for periodic. Do not use these accounts for perpetual. Purchases, purchase returns and allowances, purchase discounts, freight in. When you're doing perpetual, you will only use the inventory account for this. All right, let's start. Now we're going to Jennifer's books. Periodic inventory, we're going to do the same transactions we did for Jennifer's office supplies in perpetual, but now we're doing periodic. Journal entry, purchase of merchandise. We're going to debit purchases and credit accounts payable. So what kind of account is purchases? It is a temporary account. It will be closed at the end of the fiscal period, but for right now we're using it to track our purchases. We have freight, 140. We're going to use a new account, debit freight in, credit cash. Freight in is also a temporary account. It will be closed at the end of the fiscal period. And again, we have the returns, 2 calculators, $130 each, debit accounts payable, but we're going to credit purchase returns and allowances. New account, temporary. Now let's take a quick look here. Let's go back and look at purchases. Normal balance for purchases is a debit. Normal balance for purchase returns is a credit. It is a contra account. And also when Jennifer pays her bill, same transactions, debit to accounts payable, credit to cash for the 98%. We're taking a 2% discount. We're taking a 2% discount, and we're going to credit purchase discounts. Purchase discounts has a normal credit balance. All right, let's take another look at that statement. So we've got, now I'm using year-end balances in these. We're not just using those transactions, and that's why these numbers are so much higher than the last journal entries that I did. So let's say we get to this point for Jennifer's office supplies. We do a physical inventory, and we calculate the cost of goods sold must be $142,200. We have to make an adjusting journal entry. We have to clear out all the balances in these temporary accounts and update. We have to update the inventory account to reflect what we physically counted. We have to update the cost of goods sold account to reflect what we calculated, and we have to eliminate the balances in these other accounts. So here's our adjusting journal entry. Now remember, merchandise inventory is not going to be the balance that we counted. It's going to be whatever it takes to adjust from the beginning balance of 11,000 to the ending balance of 11,850. So we needed to increase merchandise inventory by 850. Cost of goods sold is only booked at the end of the years. So here we go with the full amount. And then this is just to eliminate these balances. We had a balance of 11,200 in purchase returns. We're going to debit it. Its normal balance is a credit. We're going to debit it. Purchase discounts, normal balance is a credit. We're going to debit it. And purchases we're going to eliminate by crediting. All right, the main difference between periodic and perpetual is the point at which cost of goods sold is computed. Companies that use periodic inventory to take a physical count to determine ending inventory and to calculate cost of goods sold. They do not know what cost of goods sold is until they determine what their ending inventory is. However, companies that use perpetual inventory also must take a physical count to check the accuracy of the book inventory to the actual physical inventory. Just because you do perpetual doesn't mean, it means you still must take a physical inventory. So here's a side-by-side comparison, perpetual versus periodic. And you can see how in perpetual we use the merchandise inventory account, and in periodic we use these new accounts. Those are the purchase transactions, and here's the sales transactions. And you can see they're pretty similar, except that for perpetual we have these additional tracking of cost of goods sold because we're tracking it perpetually. This ends part 5 of merchandising. This is the last video for merchandising. Our next videos will cover inventories and cost flow assumptions.